In addition to manually closing trades at the current market price through market orders, you have the option to utilize exit orders to establish predetermined levels for maximum profit or loss. What are exit orders? Exit orders function similarly to entry orders, with the difference being that they are used to instruct your broker or trading provider to close a trade when the market reaches a predetermined level. Exit orders can serve as either stops or limits. Limits are commonly referred to as take-profit orders, while stops are known as stop-loss orders. These terms accurately describe their respective purposes. Limits are used to secure a specified amount of profit, while stops are employed to close a position if it reaches a predetermined level of loss. What are take-profits? Take-profit orders are a valuable tool in trading that allow you to set predetermined exit points for your positions. These orders automatically close a trade when the price reaches a specified level that is more favorable than the current market price. By utilizing take-profit orders, you can maintain discipline in your trading strategy and avoid unnecessary pursuit of profits. Let's consider an example. Suppose you enter a trade on GBP or USD at 1.3260 and intend to close it when the price reaches 1.3300, resulting in a profit of 40 pips. By setting a take profit at 1.3300, you create an order that will automatically close your position when the price reaches that level. This allows you to secure your desired profit without constantly monitoring the market. Take profit orders serve as a risk management tool, ensuring that you capitalize on favorable price movements and lock in profits according to your trading plan. What are stop losses? Stop-loss orders are vital tools in trading that allow you to automatically close a position if the price reaches a predetermined level that is less favorable than the current market price. These orders help minimize losses by providing an exit strategy when the price moves against your position. Let's continue with our previous example. Suppose you aim to secure a profit of 40 pips by buying GBP or USD but are concerned about potential market reversals. To limit your potential losses to a maximum of 25 pips, you set a stop loss of 1.3235. If the price reaches this level, the stop loss order triggers and closes your position, minimizing your losses. There are two types of stop losses: standard stops and trailing stops. Standard stops. Standard stops work as described above. You set a specific distance, in points, from the current price of your trade. If the market reaches your specified level, the stop loss is triggered and your position is closed. Trailing stops. Trailing stops, on the other hand, dynamically adjust as the market moves in your favor, helping protect your profits without limiting their potential. Similar to standard stops, you set a trailing stop a specific distance from the current price of your trade. However, if the market moves in your direction, the trailing stop moves accordingly, maintaining the same distance below or above if you are short the current price. If the market starts moving against you, the trailing stop remains in place. If the market continues to reverse, eventually reaching your trailing stop level, it triggers and closes your position, safeguarding any profits you had accumulated up until that point. For example, let's say you buy EUR USD at 1.7045 with a trailing stop set 30 pips away. If the pair moves up to 1.7080, your trailing stop will adjust to 1.7050. If the market then reverses by 30 pips, the trailing stop will remain at 1.7050 and trigger, locking in a profit of 5 pips. Stop-loss orders, whether standard or trailing, play a crucial role in managing risk and protecting your capital in trading scenarios.